To Europe now, and after marathon talks, Europe's leaders have come up with a framework to deal with the debt crisis. Much has yet to be worked out, but the headlines have encouraged recapitalisation of the banks to the tune of €100 billion, a 50% haircut for Greek bondholders, and leveraging the existing rescue fund to €1 trillion. Well, I'm joined now from the London Stock Exchange studios by Jamie Dannhauser from the Lombard Street Research. Jamie, welcome.
Good evening.
Well, all the leaders seem very pleased with themselves that they have delivered. Is it enough?
I'm sure they're pleased with themselves. The devil will be in the detail. We have a lot of promises on the table. Frankly, they were the same promises that were leaked over the weekend. So there really hasn't been that much new information in the last few days. But frankly, we need to know what is in the detail. In fact, how will the leveraging up of the EFSF take place? What will the ECB now do in response? What will happen to monetary policy in the Eurozone? So there are a lot of unanswered questions.
Is there, in your view, going to be enough help to sort out both the Greek banking system, making sure that that stays afloat, and indeed the financial position of the Greek government?
Well, I think what's fairly remarkable about the haircut that's been agreed, the 50% cut in the face value of Greek bonds, is the numbers being bandied around this morning suggest that that only brings the government debt ratio down to 120% of GDP in 2020. So even with this very large upfront haircut, it's still clearly the case that the Greek government is bust, so more will need to be done. So there's no sense this deal is really dealing with the fundamental problem of insolvency in the Greek government. So that problem really hasn't been addressed at all. When it comes to the Greek banks, clearly there are going to be recapitalisation funds put on the table. Clearly that's got to happen as part of the plan. But as far as I'm concerned, we still are not dealing with the fundamental problem with Greece, and that is its bust.
I see a lot of the banks. I've seen a few numbers out this morning from the BBC on what banks need to raise and how they might be rushing to the bailout fund for help. Greece, €30 billion, Spain, 26 billion, Italy, 15 billion. That's a lot of money.
It certainly is. I mean, the aggregate numbers in the region of €100 billion. We don't know the exact numbers, but these are the numbers that are being estimated at this stage. They are very large numbers. The sad fact is this could have all happened 18 months ago had European leaders been willing to accept the reality of the situation they face. The simple fact is they've done very little for 18 months, and that means we've lost 18 months of time to put in place proper reforms.
A 50% haircut on this Greek debt does mean that some debt is going to be written off. But are you worried that we're going to get a sort of round robin of debt, and with debt getting shuffled from bank to government, from government to government, from government to European fund, from European fund back to government?
Well, I mean, absolutely. I mean, this is one of the worries. Because we have no detail exactly how the EFSF will be leveraged up to €1 trillion, it's not clear which credit is going to ultimately stand behind this fund. And that really is the problem. Europe has a big debt problem, not just a government debt problem, but an even larger private debt problem. Far too much of the debate about the Eurozone crisis focuses on the government issue, when really the problem in countries like Portugal, in Spain and in Ireland is one of private debt and banks that have lent too much money to the private sector. And the debate really does.
You're suggesting, I think, that Portugal might be next in terms of market focus.
Very much so. I mean, my view has always been that this grand plan, this grand deal, had to look at Portugal as well, and probably Ireland, because the simple fact is, on the IMF's current numbers, Portugal is going to have a government debt ratio in a few years of 115% of GDP, and those, in my view, are based on already optimistic growth projections. So if the debt ratio is going to be even higher than that, there really has to be a large question mark about how long it will take for market focus to move to Portugal, where the problem of the private sector is many times worse than it is in Greece.
Finally, it's been suggested that President Sarkozy is already hitting the phones to China to contribute to the bailout fund. Do you think that is indeed what will happen? We'll get more BRIC input here?
Well, it's a solution, and on a global level, it's quite a desirable solution in the sense we do still have this enormous problem of global imbalances and large imbalances in capital flows. So the use of China and the BRIC countries is a positive step. But I would like to see Europe getting its own house in order and some recognition of the real problem. And this has been the underlying issue with this whole crisis, that nobody in Europe is willing to come on the table and lay down what is actually going on, what has actually gone wrong.
All right, Jamie Dannhauser, one small step. Thank you very much for joining us.
Thank you for having me.